Hello traders, you're welcome to this video and you're welcome back to the Forex Geek channel. So in this particular video, we are going to be looking at a powerful strategy that combines two of the most popular momentum indicators in Forex trading. And these indicators are Stochastic Oscillator and the MACD. So if you are looking to improve your entries and exits, then this video is for you. So let us start with a quick overview of each indicator. All right, first up, the stochastic oscillator. I'm going to be loading the stochastic oscillator to the chart so we can see it here. The stochastic oscillator measures momentum and tells us whether an asset is overbought or oversold. When the oscillator hits a certain level, we get a hint about the potential direction the price might take. So the overbought level, it's between 80 and 100, while the oversold level is between 20 and 0. Okay, the general rule here is that when the stochastic is above 80, we consider the asset overbought. When it's below 20, it is oversold. Pretty straightforward, right? Now, these levels help traders spot reversal points, making it a solid tool for timing entries and exits. Now, let us talk about the MACD. So I'm going to be adding the MACD to the chart, and this is the MACD, all right? The MACD stands for Moving Average Convergence Divergence. The MACD helps traders see trend direction and momentum. All right, it is made up of the MACD line and the signal line plus a histogram that shows the difference between these two lines. All right, now when the MACD line crosses above the zero level, it's often a bullish signal, and when it crosses below, it's usually bearish. All right, so why use these two indicators together? The stochastic oscillator helps us to spot overbought and oversold conditions, while the MACD tells us more about trend momentum. Combining them can help filter out some false signals and confirm whether a trend is strong enough to follow or likely to reverse. Okay, so imagine the stochastic gives us a potential buy signal in an oversold zone, for example, here. All right, and then we have confirmed that the price of the asset has dropped for a while. All right, the MACD can help us confirm if the momentum is also aligning with that signal. So we're just going to check out the MACD and know whether the MACD is giving us a buy signal or not. In this situation, we can see that we are not exactly having a buy signal. So you can see that eventually the buy move was just a little. All right, so just a little. Okay, now let us get into the strategy setup. We will need to apply both indicators to our chart, which we have already done here, and we're just going to be using the default settings for this strategy. Okay, so let us look at an example of how this strategy works in action. This is the 1 minute chart, but I'm going to be going to the daily chart so that we're going to avoid a lot of noise. All right, now here is the daily chart on GBP JPY currency pair. Okay, so we're just going to be looking at an example of how to use the strategy combining both oscillators. So in this situation, we can see that we had a buy signal right around here, as we had the main line of the stochastic cross above the signal line in the oversold territory, but we didn't exactly have a confirmation from the MACD, so we should have ignored this signal because we are looking for a confirmation from the MACD, right? So here again, we had another buy signal, and this time around, we had a confirmation from the MACD. So this would have been a good spot to buy, right? After we had this bullish crossover and we had the MACD line cross above the zero line. So we would have entered a buy around here and then set stop loss, a tight stop loss just below the swing low, right? Or if you want a wider stop loss, to give the market more breathing space, then you can set it below the swing low that preceded this, right? And then as for your take profit, you can just use the nearest resistance zone, or you can just wait for the stochastic oscillator to enter the overbought territory and begin to point downwards. Or you can also wait for the MACD line to cut below the zero line again, whichever option that you prefer. Alright, so basically that is how to use both indicators. Make sure you always get a confirmation. You will use the stochastic to find the signal and then wait for a corresponding confirmation from the MACD, or a corresponding signal rather from the MACD. All right. So after you have done that, it's also important for you to know how to manage risk, for you to know what lot sizes to use. So when you want to enter a position, make sure that you do your calculation properly. It is ideal that you do not risk more than 1 to 2% of your capital in one trade. Okay, so when you have identified a good buy or sell opportunity, the next thing for you to do is to calculate your lot size. Okay, so based on your capital, you should find 1% or 2% of that capital and then risk a maximum of that amount in that single trade. Okay, so and then when it comes to your stop loss and take profit, it's ideal that you have a good risk to reward ratio. I will recommend minimum of 1 to 2. So it means if you are risking $1, you should be targeting to make a minimum of $2. All right. So that is what we call risk to reward ratio. Risk to reward ratio. Now, some quick tips for using this strategy effectively. First, remember to look for alignment between the stochastic oscillator and the MACD. If the stochastic is signaling overbought, but the MACD hasn't crossed down yet, consider waiting for confirmation from the MACD before entering a short trade. All right. Secondly, adjust your settings based on the time frame. Shorter time frames might need quicker adjustments, while longer time frames often use the default settings. So if you are a scalper, you can actually decide to modify the settings of the indicators. For example, you can decide to change the stochastic period. You can decide to reduce it a bit because the lower it is, the faster it reacts to price changes. So it depends on what suits you best. You can actually experiment with a couple of values and find out which one suits your trading style best. All right. So whether you are a day trader or a scalper, you can actually find what values work best for you. Okay. And lastly, use this strategy in trending markets for the best results. If you are trading in a range, you might get mixed signals. So it's ideal to apply it when there is a clear trend direction. Okay, and that is it for this video. We have been able to break down, the stochastic and MACD strategy. By combining these indicators, you can add precision to your trading and hopefully reduce false signals. It takes patience and practice, so try it out on a demo account and see how it works for you. If you found this video helpful, make sure to hit the like button and subscribe to the channel for more content just like this. We are building a community of traders who are passionate about mastering Forex strategies, so stick around for more tips and techniques. Until next time, stay safe, trade smart, and stay profitable. See you in the next video.